The reason why I wanted to feature Warner Brothers Discovery is because of earnings. And earnings were reported after market close yesterday. And so you can see right here, the earnings looks like they estimated that they would come ahead about a little under 2 cents a share, and instead they wound up losing 95 cents a share as a company. But I wanted to feature this one because last week I talked about a strategy of um, profiting off of an earnings play if you have an idea of the direction things are going, and I had an idea of the direction going down. um, you can profit off of this natural tendency. This is what happens as earnings approaches. People get kind of afraid, and they get afraid. And the way that we can measure this is by looking at how many insurance policies they purchase on their stock. And those insurance policies are options, right? And so if we measure the price of the options as we get closer to earnings, we see this increase in the price of options due to the fact that people are buying these things up in order to protect in case something goes wrong, right? And then right after earnings is released, we see this huge sell off of the insurance policies, these options, because we don't need them anymore. And I'd like to feature that by showing you. So if I come over here and I take a look, for instance, at a particular option, and I'm going to look at an option on the weekly schedule. So I'm going to come over here and look at the weekly options. And I'm also going to look at some historical Warner Brothers data. So WBD, right? So earnings was yesterday evening. And so let's take a look at this option, weekly option. I'm going to go about 2 weeks out. This is exactly what I said to do. So about November 11th. And I want you guys to pay attention to this number that is right here, this implied volatility number. So you'll notice, like right around here, these numbers are around 108, 104, 108%, right? Now, if I come on back to what it is currently, these are the same November 11th options. Notice it's dropped to 61%. That shows us that those options were much more expensive yesterday. And then after the market close, they dropped today because people don't need them anymore. They know what's happened. The price has changed. And so I created one of those calendar spreads. So a calendar spread specifically focuses on premium. So let's take a look at my calendar spread. So I'm going to go ahead and plot it. So I used a December option, and I used a November 11th weekly option in this calendar spread. So my far out in time option was December, the third Friday in December, and my near term option was November 11th. And I'm going to come here and take a look at this. So I bought these things on November 2nd. And on November 2nd, I paid 35 cents. I paid 35 cents in order to get this. And as of when I sold it this, because I knew that this morning that these things were going to be, you know, f- dropping quite quickly, I was able to get 60 cents. And so that's playing exactly what I'm talking about, is this volatility change right before and right after earnings. It doesn't matter what the price is. Now you'll notice, if you guys are paying attention, I used puts. And that's because my long-term belief was that Warner Brothers was going to go down in price, which it did, as you look here. And I was watching it go down in price. If I take a look here, I was watching it kind of go down in price these past couple of days. So when I did this trade, I said I'm going to use puts. But I did a calendar spread so that I would focus specifically on that implied volatility. We call it a rush and then a crush. And so you'll notice that, I bought these things for 35 cents. I sold them this morning for 60 cents, took advantage of that phenomena. And this can be done during all the earnings season. The type of option you choose, whether it's a put or call, that's going to depend on what you believe is going to be going down with respect to the price. And the spread is usually about 3 months out and 2 weeks in.